Hello and welcome to Chapter 5 notes. And so what I have up here is our Chapter 5, and what we're going to start off by talking about is the traditional income statement versus the contribution margin income statement, also known as the variable costing income statement. This should look pretty familiar, so we'll go through this pretty quickly. Then we'll talk about variable costing versus full costing and then the differences. All right, so when you look over here and you see the traditional income statement, the cost of goods sold versus selling and admin are organized by function. So they're organized by product versus period costs. So these are all product costs. These are all period costs. Versus on the other hand, what we talked about before is the contribution approach, the variable costing approach, in which the costs are organized and categorized by behavior, variable costs versus fixed costs. All right. This is used for internal financial reporting. This is used for external financial reporting. You can see one reason that this would be better for internal financial reporting is that it's organized by cost behavior, so it lets us to figure out these costs on a unit basis, and we can say these are our variable costs per unit, and then we can use that quickly for cost estimation and also for cost volume profit analysis. Versus up here with cost of goods sold, if we're talking about a manufacturing company, we're pushing down some of fixed manufacturing overhead to cost of goods sold. And so this right here, if we wanted to say, let's say we're making 1,000 units and we wanted to know what would be the cost for making an additional 200 units, you can't just put this onto a unit basis and multiply it by 200 because this includes some fixed overhead. However, you could do that with the contribution approach here. You could just say, here's our variable costs. You could calculate the variable cost per unit, multiply it by the additional 200 units, and then you know that is the additional variable cost. And then the fixed cost would stay the same, assuming that we are still within the relevant range. Okay. All right, so let's go ahead and start talking about the differences here between absorption costing versus variable costing. Absorption costing is also known as full costing. Okay, synonymous. All right, so that is used for external financial reporting. Okay, cost of goods sold and inventory include all product costs. So that means they include direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Variable costing, on the other hand, is used for internal reporting. Okay, and product costs are our direct materials, direct labor, and variable manufacturing overhead. And then so the main difference between absorption costing and variable costing is you can see up here fixed overhead is treated as a product cost. It's included in inventory and cost of goods sold. Versus up here with variable costing, fixed MOH is treated as a period cost. Okay? Variable, fixed, and administrative and selling expenses are period costs always. Okay, so they're period costs under both variable costing and full costing. All right. So if we look over here, we can even see a little bit. This is just kind of graphically showing the differences, and so we can look over here with with full costing. These are product costs. That's product. This is product. So is this. And then these are all period. Okay. Versus variable costing, this is product. Direct labor is also product. Variable overhead is product. And then the difference is this is a period cost. Fixed manufacturing overhead is treated as a period cost under variable costing, but a product cost under full costing. And then these are all period. Variable and fixed selling and admin are always period costs. So the difference between the two methods, again, is this treatment of fixed overhead. That's all it is. That's the difference. Okay. Here it's a period cost, which means it comes out in that accounting period. product cost over here, which means it would show up in cost of goods sold when we sell the goods. Okay, so again, this is basically, this diagram right here is kind of illustrating the differences again of everything that I just talked about. So I'm going to go ahead and start jumping into some of the problems because I think that really actually illustrates the difference. So let's say we have our example corporation here. Harvey Corporation produces a single product with the following information. Here's our 25,000 units that we produce every year. Here's the sales price. $10 of variable overhead, direct labor, and direct materials per unit. We have selling and admin expenses of $3 per unit. We also have our fixed overhead of $150,000 total, fixed selling and admin expenses of $100,000. So now what we're going to do is calculate the unit, we'll say our unit product cost under both scenarios. We can look over here with absorption costing. It'll be 10 because we know with full costing, also known as absorption costing, as well as variable costing, that direct materials, direct labor, and variable overhead are treated as product costs. The difference comes in with fixed manufacturing overhead is not treated as a product cost under variable costing. It's treated as a period cost under variable costing. So that means our unit product cost is $10 here with variable costing. Versus over here, we have our fixed manufacturing overhead per unit. So I have to put this on a unit basis. And the way I'm going to do that is I'm going to take my total fixed manufacturing overhead divided by my units produced, 25,000, all right, which gives me $6 per unit. So I'm going to put that here because fixed manufacturing overhead is treated as a product cost under full costing. So that means our unit product cost here is $16. So you say, what did we treat as a period cost under absorption costing? Well, under absorption costing, the only thing that we would treat as period, under absorption costing, the only thing that we would treat as period are selling and admin expenses. For the variable costing, it's selling and admin and fixed manufacturing overhead. We look down here. What would always be treated as a period cost are selling and admin in both methods. Selling and admin expenses are always treated as period costs. And when would they be expensed? In the period in which they are incurred. So if we incur $50,000 worth of sales commissions in 2012, and in 2012, that will show up on the income statement. Expense means basically you can think of that as when is it going to show up on the income statement as an expense. That's the term expensed. Okay. So now let's look over here and we'll say, let's look at our example right here under full costing versus variable costing. It says right here, Harvey Corporation has no beginning inventory, okay? So they produce 25,000 units and then they sell 20,000 units. So basically what this is going to mean, of course, is that they're going to have $5,000 left over, 5,000 units left over in ending inventory, all right? So we come back over here and we need to calculate our sales. We're going to do our income statements under full costing. Is see with full costing, see how my income statement is set up. It's the traditional way because full costing is used for external financial reporting versus the variable costing, use the variable costing income statement, in which the costs are organized by cost behavior. So we look over here and we look at, well, here's our sales price is $30 and we sold 20,000 units. So 30 times the 20,000 gives us the 600,000. That's our sales. We can say our beginning inventory is 0, which we know, and then we can say our cost of goods manufactured. Well, how many goods did we manufacture? It says right here, we made 25,000 units. And what is our product cost per unit? It's $10. Okay, oh, $16. I'm looking at absorption costing. $16. So what I do is I say my 25,000 times my 16 gives me my 400,000 right here. Add these two, this is how many goods I could sell, but then I still have some ending inventory. I didn't sell everything. I didn't sell, there's 5,000 units left over in ending inventory. So what I do to get the value of my ending inventory, I say the 5,000 units that are left over in ending inventory times my $16 right there per unit, which gives me 80,000. Okay, so that means our cost of goods sold would be equal to, I'll put that over here, my 320,000. So I take my 600,000 minus my my 320,000, which will give me a gross margin, also known as gross profit, of 280,000 right there. Then I subtract out my $160,000 worth of selling and admin expenses, and let me show you how I got that. Here's my fixed selling and admin expenses, 100,000, and then plus I have to add in my variable selling and admin expenses. And it says right here, I sold 20,000 units. Each one is $3 per unit sold. So 3 times the 20 gives me 60,000. I add that to my 100,000, and that's how I got 160. Okay. I take my gross margin, also known as my gross profit, subtract out my selling and admin expenses of 160, and I get 120 right there. Okay. Let's jump down here to look at variable costing. So we have our 600,000, of course. Then we have our zero beginning inventory, and then we add in our variable manufacturing costs. Well, this is where I was looking at the 10, so now I have the $10 per unit times the 25,000 units that I made, 250,000. Goods available for sale, 250,000. Okay. Less my ending inventory, I have 5,000 units. Left over in ending inventory, okay, times the $10 per unit gives me the value of my ending inventory right here is 50,000. 250 minus the 50,000 gives me 200. That's my variable cost of goods sold. And then I add in my variable selling and admin expenses of 60,000 right there. Okay. So then what I would do to get my contribution margin, and I'll write that in, I take my 600,000 minus my 260 minus my 200 minus my 60,000 gives me a contribution margin of $340,000. I'll write that over there to highlight it. Then I subtract out my fixed selling, my fixed overhead and my fixed selling and admin expenses. So 150,000 is my fixed manufacturing overhead. Then my fixed selling and admin are 100,000. 340 minus my 250 gives me $90,000 left over. That's my net operating income. All right, so now let's talk about what happened here. Why do we have a difference in income? Look at the income here for full costing. It's 120. Look at the income here under variable costing. It's 90,000. What's going on here? Well, there's a couple of ways to think about this. First is, look, fixed manufacturing overhead. This is treated as a period cost, which means this whole $150,000 comes out in year one, regardless. It comes out in that accounting period, regardless of when we sell the goods. It comes out in that accounting period. Versus up here, where did the fixed manufacturing overhead go? Well, it comes out in cost of goods sold. And so look here at the difference between the ending inventory. $80,000 is my ending inventory under full costing. $50,000 is my ending inventory under variable costing. The difference is $30,000. What's the difference in income? It's $30,000. So really what's going on is that there is fixed overhead, fixed manufacturing overhead attached to this ending inventory, and that will be recognized in the next accounting period when we sell those goods. The fixed overhead that's attached to those 5,000 units in ending inventory, right? The $30,000 will be recognized when we sell those goods in the next accounting period under full costing. Under variable costing, though, when is the fixed overhead recognized? In that accounting period, because it's a period cost. All right. So let's go ahead and start looking at year. So if we come over here, we can compare those two methods. So we can say, of course, our cost of goods sold was under variable costing was our 200,000 versus right over here our fixed. And we have our fixed MOH. Actually, I'm just going to cross this out. I don't think we need to do that. So I'm just going to cross that out. And I'm going to cross that out because I've already kind of talked about it with respect to basically that page is kind of summarizing the differences here between our ending inventory. And the value of the ending inventory is the difference in the income. Because the ending inventory is $30,000 higher here. And basically what that difference is equal to is those 5,000 units in ending inventory times our fixed overhead per unit, $6. And it's attached to the ending inventory here, right? Because it's been pushed down to the units here because it's treated as a product cost here under full costing, but under variable costing, it's treated as a period cost, okay? So now I'm going to skip ahead to page 8 where we look at year 2, all right? So then in year 2, we say we produced 25,000, but we sold 30,000. Now how is that possible? It's because we have beginning inventory from year 1. Remember with year 1, we look back over here on your page 6, it says right here we produced 25,000, we sold 20,000. So that means at the end of year 1 we have 5,000 units in ending inventory. That becomes beginning inventory for year 2. All right. So now we have the exact same thing. So we have the 10, and of course we have the 6 here, and then the 0. And the way I got that 6 was taking that 150,000 total fixed overhead divided by our units produced. Gives me $6, 16, and then 10. Okay. All right. So now let's do our income statements for year 2 for Harvey Corporation, and what we're going to see is a difference in income again. So now what we say is our sales. Now if we look back at the problem, it says we sold 30,000 units. The selling price is $30 a unit. So I get sales of 900,000. I come over here and I have my beginning inventory. Well, remember, I have beginning inventory of 5,000 units. Okay, beginning inventory of 5,000 units, and we could also look at the end of year 1 to see what the value of that ending inventory is, 80,000, but that becomes beginning inventory for year 2. So I'll just put the $80,000 there. Add in our cost of goods manufacturing, and it says right here for year 2, we made an additional 25,000 units. 25,000 units times the 16 is our 400,000. Okay, goods available for sale, 480. There is no ending inventory. Okay, and why is that? We made 25,000, and then we had the 5,000 beginning, and then 25,000 plus the 5,000 equals the 30,000 that we sold. So we sold everything that we have. Okay, so we have 0 right here. So it gives us our cost of goods sold of 480. Okay, we subtract these two, gives us our gross profit of 420. And then of course we take out our selling and admin expenses, and that's going to be 190. And the way I got that is by taking the 30,000 units sold times the $3 per unit, which gives me 90,000, and then adding in my fixed selling and admin of 100 gives me 190. Subtract the 2, I get 230. Okay. We come over here and we look at our sales. It's 900,000 again, and then we have our variable cost of goods sold. Let's go through and calculate that. Well, if we look back at the end of year 1, look at the value of our ending inventory at year 1, 50,000. That becomes beginning inventory for year 2, 50,000, plus our variable manufacturing cost is going to be equal to the 25,000 units that we produced times the $10 per unit. Gives us 250,000 right there. Okay, 0 beginning inventory. That gives us cost of goods for sale 300,000. 0 ending inventory. That's what I meant to say, which gives us our variable cost of goods sold of our 300,000. Okay, and then what we have is our variable selling cost of 90,000. So you take the 900,000 minus the 390, and then what you get is the 510 contribution margin. Okay, we take out our fixed overhead because we're treating it as a period cost, fixed selling and admin. The 510 minus our 250 gives us 260,000 net operating income. Okay, versus 230 up here. So what happened? Well, again, why is there a difference? And there's a difference because look at the value of the beginning inventory right here. It's 80,000 versus 50,000. Again, what's the difference? $30,000. What is that $30,000? That is the 5,000 units times the $6 of fixed manufacturing overhead per unit. That's what gives us the $30,000. And that is the difference between the two methods. Because remember, with full costing, fixed manufacturing overhead shows up in inventory. It shows up in cost of goods sold because it is a product cost. With variable costing, fixed manufacturing overhead is treated as a period cost, which means it shows up on the income statement in the period in which it's incurred. So in year one, when you produced more than you sold, you are basically deferring some of that cost of goods sold until you sold those products and that's why income was higher under full costing when you produced more than you sold in year one than it was under variable costing. But then you come over to year two when you actually sold more than you produced because you sold off your beginning inventory. In that situation, what you have is the reverse, that variable costing income will be higher than full costing income. Because look at the difference in beginning inventory. Because you're selling off those goods right here. But here, it's treated as a period cost, but look at the difference in the inventory. And that's what shows up in the net operating income. Okay? So again, I'm going to go ahead and skip this page. Okay? Because I've kind of talked about it. So we're going to keep on going. Let's look at page 11, where we look at the summary of the effects on income. Okay, so we come over here. Oh, let me catch up. It says if production equals sales, there's no change in inventory, no effect on inventory. Okay, but in that case, when production equals sales, full costing net income equals variable costing net income. Okay. We come over here and we say our production is greater than sales, which is what happened in year one of the Harvey. Inventory increases, right? Our ending inventory increases. And then what that does again is it moves some of that fixed overhead to ending inventory, which means we're basically going to recognize that in the period in which we sell it. So we're going to defer it to the next accounting period when we sell those goods. So the fixed overhead that's attached to those goods will be recognized in the next accounting period when we sell them. So that means we're effectively reducing our cost of goods sold because we're going to recognize it in the next accounting period in which we sell it. So that's why full costing net income was more than variable costing income. Okay? Then we come over here and we look at the situation where production was less than sales when we sold off. That was Harvey year two. When we sold off our beginning inventory, what happens, right, is inventory goes down because we sold off our beginning inventory, and that means that variable costing income will be more than full costing income. And always the difference between the two is that fixed overhead that's attached to inventory. Okay. I'm actually going to come back to page 10, and I am going to look at this. I think actually I'm going to go ahead and keep this. So what I have right over here, if we look back into year two, we have the $260,000 worth of variable costing income, and what we had is our $30,000. I'm going to cross that out, and we're going to say subtract. Subtract the fixed manufacturing overhead cost, right? That's in inventory, the $30,000, and the way I got that was my 5,000 units times my $6 of fixed overhead per unit. That gives us the $230. So again, I wanted to show you this because this part at least because it shows you how to reconcile the two. Okay, and basically the difference again is always the amount of fixed overhead that's attached to the units in ending or beginning inventory. That will always be the difference between the two methods. Okay? Sorry, so let me now catch up here to page 12. We don't need to look at that. I'm going to cross that out, and I'm going to look at the advantages to our variable costing and our contribution approach to our income statement. Okay? So I've kind of talked about this before in the earlier chapter, back in chapter 4, where it says the data for CVP can be taken directly from our contribution format income statement. We explicitly show the fixed costs and we explicitly show the variable costs. The problem, right, is that managers will often assume that all unit product costs are variable, but that's not true. under full costing because we push the fixed overhead down to the units, but under variable costing, that assumption would be true. Variable costing is going to make it easier to estimate our profitability and also for cost estimation. Okay. Variable costing and using our variable costing income statement, but also variable costing in general, in which we treat fixed manufacturing overhead, reduces the limits the management of earnings with production volume. So what we saw with year one, remember what we saw with year one with Harvey, is that when we overproduce, when we produce more than what we sold, we are putting some of that fixed manufacturing overhead in ending inventory, which means we are deferring that cost of goods sold, right, until the next accounting period when we sell it. So we can basically, if we needed to make our numbers, if we were being evaluated based on net income, if we're a manager and being evaluated based on net income, what I could do is produce more than I sell, push off that fixed manufacturing overhead until the next accounting period when I sell those goods, overproduce, which then pushes down that cost of goods sold, and then I can meet my numbers by playing around with production volume. Okay, so if we look over here and we look at this example, it says suppose the manager expects sales to be 1,000 units. The selling price per unit is 100. Variable production costs are 50. Fixed production costs, fixed overhead are $45,000. If the manager produces 1,000 units, profits would be equal to $5,000 under both full and variable costing. So in this case, we sold 1,000. We produced 1,000. Production equals sales. Full costing income equals variable costing income. Both are 5,000. However, a savvy manager could realize that if he overproduces, he produces 2,000 units, but only sells 1,000 units, that he or she will make more money, make more profit under full costing than he or she would under variable costing. And profits would be actually $22,500 higher under full costing than under variable costing, and that's because some of that fixed manufacturing overhead will be attached to those 1,000 units in ending inventory, and that fixed manufacturing overhead will be recognized. It will show up as an expense on the income statement in the next accounting period in which they are sold. Okay? All right? So full costing right here allows a manager to increase income in a period by increasing production even if there's no customer demand. Managers may take this route if their bonus is based upon absorption costing income. Okay, and that's known as producing for inventory. Producing for inventory could cause some undesirable effects, some unintended consequences. Plant manager may accept a particular order to increase production, even though another plant in the same company may be better suited to handle the order. To meet increased production, a manager could defer maintenance beyond the current accounting period. Although operating income in this period may increase as a result, future operating income will be decreased because we have less efficient equipment. Okay? There are also limits, and this makes intuitive sense, right, to how much you can overproduce because we have physical storage space. Okay? So there's some ways to reduce the undesirable effects of using full costing. We could have careful budgeting and planning to reduce management's freedom to build up excessive inventory. We could have monthly budget balance sheets, have estimates of the dollar amount of inventories, and we could compare those to the actual, the budgeted to the actual. We could use variable costing for internal reporting and hold people accountable using variable costing. Okay? We could evaluate performance over multiple years rather than just annually, and we could include some non-financial measures. We could look at ending inventory, for example. Okay, I'm going to skip this on just-in-time inventory, and so we're here on page 16. These exercises, these are posted in Chapter 5 Solutions on Canvas. So I will let you do those and then go ahead and take a look at those solutions that are posted up on Canvas. But we'll go ahead and jump ahead to page 20 where we have some additional problems right here. Page 20 and page 21. Let me catch up. Okay, let me move this over here. Give me a second here. Okay, almost there. Hold on. So what we have is our Captain Carl. So it says right here, Captain Carl experienced the following costs in 2007. All right, so what we have is our direct materials, we have our direct labor, we have our variable overhead, variable manufacturing costs, and we have our fixed manufacturing costs, and we have our selling and admin costs right here in variable selling, and then fixed administrative. It says right here, during the year the company made 50,000 units and sold 45,000 units, right? So we produced more than we sold. So we know right off the bat, because we produced more than we sold, that full costing income is going to be higher than variable costing net income. Okay? So what I'm saying right here, this is kind of a tricky problem, because it says if net income for the year was 265 using full costing, what is it using variable costing? You might look up here and you say, well, I have no idea because I don't have the sales price. But you can figure this out. You have to be a little bit clever to do it. And you also have to remember that the difference between variable costing net income, variable costing income, and full costing income is the amount of fixed manufacturing overhead attached to inventory. Okay, pushed down to inventory. And so we know that. And we also know that full costing net income will be higher than variable costing in net income. And it will be higher in this case by the amount of fixed overhead that is attached to ending inventory. Okay? So the first thing that we have to do, step one to figure out this problem, is determine the amount of fixed overhead per unit. Okay? And the way I determine the amount of fixed overhead per unit is I take my total fixed overhead divided by my units produced. It's always divided by my units produced, not divided by my units sold. Okay? Because we apply overhead when we produce the units. Okay? So that gives us $3 per unit. Okay? Then I come over here and I say, well, how many units are left over in ending inventory? Well, I've got 50,000 that I made, 45,000 that I sold, I have 5,000 units. And then I multiply that times the $3 of fixed manufacturing overhead per unit, and that gives me $15,000. That is going to be the difference. Remember, the difference between the profit under full costing versus variable costing is always equal to the amount of fixed overhead in inventory. In this case, it's the amount of fixed overhead in ending inventory. So, $15,000 is going to be the difference between the two net incomes. And then I know that because I produced more than I sold, that income under full costing will be higher than income under variable costing. And I know the amount of difference between the two profits is $15,000. So what I do is I take my 265, which is my income under full costing, minus my $15,000, gives me $250, and that is the income under variable costing. Okay. All right, so let's look at this one right here. This is the second one. Randy.com is a direct marketer of popular music. Okay, the following is information about its revenue and cost structure. So we have our selling price, we have our production, we have our selling and admin costs, we have our production costs, fixed manufacturing overhead, and then our fixed selling and admin costs right here. So it says use the data above to answer the following questions. And it says the first one, assume that 400,000 CDs are produced and 350,000 CDs are sold in 2008. What's income? Excuse me. What is income going to be under variable costing? Well, I'm going to come over here. I'm going to say my sales. Well, I sold 350,000. I sold each one for $15. So I say 15 times my 350,000 gives me $5,250,000 in sales. All right. Then I calculate my variable cost of goods sold, V cost of goods sold. The way I can do that is I can do the whole beginning inventory plus additional manufacturer cost minus ending inventory. I can do that. Or the easier way is to say, well, how many units did I sell? 350,000. And then what I do, remember, since we're using variable costing, it is going to be, this is times $3 right there. Okay, so 350,000 units sold times $3 variable cost, variable product cost per CD gives me $1,050,000 right there. Okay, Then I also have to subtract out my variable selling costs, and that's $1 per unit times my 350 times my 350. So then what I can do is calculate my contribution margin. Is my contribution margin is to be equal to my $5,250,000 minus my $1,050,000 minus my $350,000, and what that's going to give me is my $3,850,000 right there. It will give me my contribution margin, and I subtract out my fixed MOH, because remember, under variable costing, fixed manufacturing overhead, this is fixed manufacturing overhead, is treated as a period cost. And then I subtract out my fixed selling and admin, which is given to me right up here, of $2 million. And what I get is income of $850,000. Okay, that is going to be income under variable costing. All right. So now let's look at the second question over here, where it says, what's income going to be under full costing? Okay, and there's a couple different ways that we can do this. The easiest way to do it is to say, all right, so what we're going to have right over here is we're going to take our, let me just write it out. So I have my sales of $5,250,000, right? And then what I'm going to have to do is calculate my cost of goods sold, which is going to be equal to my $1,925,000. And the way I calculated my cost of goods sold right there, well, we look back over here at what we did is, remember, we had our $1,050,000. This is my variable cost of goods sold, which is equal to my $350,000 times my $3, my $350,000 times my $3. So I have my $1,050,000 right there, okay, plus my $875,000, and this $875,000 is my fixed manufacturing overhead. Okay, and the way I got that is I come over here and I have to figure out my fixed manufacturing overhead per unit. So I'll write that over here. Fixed MOH per unit is going to be equal to our total fixed manufacturing overhead of $1 million divided by my units produced of 400,000, which gives me 2.5. So then what I do is I say 2.5 times my 350,000, and that gives me my 875, and I add that to my 1,050,000, gives me cost of goods sold right here of my 1,925,000. So then what I have is my gross margin. I take my sales, my cost of goods sold, to give me my gross margin, also known as my gross profit, gives me 3,325,000, and then I subtract out my fixed and variable selling and admin, which really you would just say you're selling and admin. You wouldn't say fixed and variable. You would just say selling and admin expenses, since we're using it the traditional way, which would be equal to our $2,350,000. Take our $3,325,000 minus our $2,350,000, and what you get is $975,000. Okay, you get $975,000. That would be net income under full costing. We look over here and it says, assume 400,000 CDs are produced and 350,000 are sold. What is the value of ending inventory under variable costing? Well, we have 50,000 units, and then of course the only thing that we treat as product costs under variable costing are the variable product costs. So it's times the 3 gives us 150,000. Look over here. What is ending inventory under full costing? Well, remember, it's our 3 of variable product costs plus our 2.5 of fixed MOH per unit gives us $5.50 per unit product costs. Okay, so we go 550 times the 50,000 units gives me my 275. Okay, this is the value of ending inventory under full costing. So now what we can do is we can say, all right, remember the value of ending inventory under variable costing. So under variable, it was 150. Under full, it's 275. You subtract the 2, and the difference is 125. So let's see if we can't reconcile this, right? How did we get to this 125? Right? Well, I mean, we see how we got that. We subtracted it, but let's see if we can't reconcile it with respect to the fixed overhead per unit. So basically, remember, the difference between the two net incomes is the amount of fixed overhead trapped, or I should say not trapped, but attached to those units in inventory. In this case, it's not beginning inventory, it's an ending inventory, because we don't have beginning inventory, we only have ending inventory. So it's the difference in the net incomes between variable and full costing will always, in this case, is equal to the amount of fixed overhead attached to those goods in ending inventory. So how do we figure out how much fixed overhead is wrapped up or attached to those units in ending inventory? Well, we say how many units are in ending inventory, 50,000 units, times the amount of fixed overhead per unit, right? Times 2.5, that gives us our 125, and then that is also the difference between the two net incomes, which is also the difference between the two values of the ending inventory. If you look back over here, whoops, give me a second. Look back over here, you can see our 850, this is our net income under variable costing, 975 our net income under full costing. The difference between the two net incomes is the 125, which is also equal to the difference between the ending inventory. And the reason that we have that difference between the two ending inventories is because fixed overhead is attached to units in ending inventory under full costing, but it is treated, fixed overhead is treated as a period cost under variable costing. Okay, hope that was helpful. That concludes Chapter 5 notes. Thanks so much.